Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. The movie Seven is a 1995 crime thriller classic. If you haven't seen it, you will need a strong stomach, so be warned. There's a lot of violence, some truly memorable scenes, and some rather revolting underlying questions being asked. So it's a bit like the markets have been recently then, but instead of the 7 deadly sins and associated crimes, it's the Magnificent Seven, or at least the Spectacular Six. I'm willing to go back up to 7 if we swap out Tesla and we put in Netflix instead. With the US market facing huge selling pressure and great uncertainty, are there dips that I've been buying among these names, or have I been avoiding it altogether? This podcast will dig into each of the Magnificent Seven and what I've done in the past week, if anything. Let's start with the ones that I'm avoiding, and I may as well start with the one that I pretty much always avoid, and that is Tesla. Down 37.5% thus far this year. The combination of Musk's antics, global competition in the EV space, and of course the risks of a trade war and what that could do for demand for American products in China are all really relevant. I must point out though, to be fair, that over 12 months, Tesla is actually up 44.5% and has thus outperformed the Magnificent Seven peers. Much of this was a direct result of Trump winning the election, with the market deciding that Elon Musk was the right trade, with very little relevance to what was actually going on at Tesla. I just avoid this thing entirely, whether on the way up or on the way down. Tesla is basically a meme stock masquerading as a serious investment. At the end of the day, until everyone suddenly loves the thought of full self-driving, it really is just a car company, and car companies are not doing so well right now. Moving on, Apple has been hardest hit of the rest thus far in 2025. The share price is down 24% at time of recording, and that reflects the supply chain risks within Apple, what the tariffs will mean for the affordability of the products, and frankly, it was also just one of the more vulnerable valuations in my books because Apple hasn't had a true hardware winner in a long time. The iPhone changed the world, but that really was a long time ago. That was before the global financial crisis that came bursting onto the scenes. And everything after that has been iterative, not revolutionary. Sure, there are good arguments to be made about the number of devices out there and how this drives the high margin services business over time. But the reality is that Apple has been trading off its brand rather than its products for a long time now. I don't know about you, but I don't think that everyone will be walking around wearing fancy goggles in the same way that we've all had smartphones in our pockets. I do have Apple exposure, but I actually think I have too much Apple exposure relative to some of the rest. And I'm not adding to it here unless we see a massive capitulation in the share price, and I can see that life after tariffs will be manageable for Apple. Next on the list is Nvidia, down almost 20% this year. What will tariffs mean for demand for hardware? What could it mean for broader economic activity and thus the demand for cloud services and the budgets for large AI projects with unproven economics? And of course, there's the direct impact of these supply chain disasters and the risks of things shifting over time in a way that is not favorable to Nvidia. Enough questions have clearly been raised in the minds of investors that they have headed for the exit. I don't currently have a position in Nvidia, and I don't plan to, because I do think it requires a deep understanding of the underlying technology. I would wager that most people who have bought the Nvidia hype in the past couple of years are not tech experts, and that's when it's getting quite dangerous out there. We then move on to Alphabet, the parent company of Google, which has taken an 18.5% bath at this stage. Again, I'm not rushing to buy this. In fact, the Alphabet business model generally doesn't excite me, other than the powerhouse that is YouTube. The cloud business is very focused on the productivity suite, the typical Google tools, all the replacements for Word and Excel, and that stuff's a pretty poor replacement for Microsoft. They win a lot more business among SMEs than among large, resilient enterprises. And this makes the Alphabet customer base less resistant to a recession. Also, it really does feel like everyone and their dog is trying to disrupt search at the moment with tools like AI. So why would I want to be overweight the market leader when there's clearly so much potential disruption? And Alphabet is even irritating its own client base because Google's AI, in case you haven't noticed, is now not sending people to websites anymore. You're not using Google that often to find a website. You're using it to just get an answer that it read on someone else's website who used to earn advertising revenue. How long does that last for? Does that sound like a sustainable business model to you? I have my doubts about Alphabet, I'll be honest. And Amazon is also on the ropes, down 17.5%. The tariffs have an obvious impact here, right? Because they could limit purchases of imported items that are suddenly far more expensive. And the problem here is that Amazon has been investing heavily in capacity in its e-commerce play and has made much progress in this regard. The very last thing they need is a knock to online shopping volumes, leaving them with vast infrastructure costs and not enough revenue. I don't currently have a position in Amazon other than what I hold through market indices, obviously, and I'm not about to add an e-commerce and logistics play to my portfolio in the early stages of a trade war. Just doesn't seem like a sensible dip to be buying right now. So that's now 5 companies in the no bucket for me in terms of whether this dip has dipped enough for me to buy them. The underlying point here is that, in my opinion, you need to be really picky when you're looking at stocks facing this much uncertainty, especially when these stocks are already a major component of any index, like an ETF that you perhaps own that tracks the Nasdaq or the S&P 500. The answer might be different if we end up 30% down, then some of the stuff may well look more interesting, but we're not there right now, and we may not even get there. No one knows. Now we can move on to the ones I either am buying or would buy if not for my existing extent of exposure. So I'll start with Microsoft so that point makes sense. I am not currently buying Microsoft, but that is only because I am really overweight Microsoft in my own portfolio. I've spoken about it before on Supernatural Stocks and various platforms as to why I believe so strongly in the business. If I wasn't overweight, this is a dip that I would be taking very seriously, but for me to add more, given my current positioning, it needs to drop a lot more. Currently, it's down 9.5% this year, which is a fairly minor correction. Hence why I say I would look for a better entry point here for myself. And you can refer to last week's Supernatural Stocks episode on why blanket stock tips are so dangerous, because they should always be seen in the context of existing positioning, which is why I'm sharing with you that whilst I do think that Microsoft is interesting right now, I'm not buying it because I have too much of it. Moving on from my positioning to why I like Microsoft, just briefly, the reality is that the house that Satya has built remains a powerhouse. Microsoft is the fabric of modern computing. They have an enterprise software business that nobody else even comes close to. Are they exposed to recession risks? Yes, they are, particularly in the cloud space. Do they have the ability to slow down their investment in this space in response to a recession? Yes, they do. And most importantly, are they still incredibly strong over the long term? In my opinion, yes, they are. So if I didn't have any exposure whatsoever to Microsoft, I probably would be dipping my toes in at these levels while making sure that I leave money in reserve to keep buying Microsoft if that share price does keep dropping. We then reach Meta, the last of the Magnificent Seven. Down just 7% year to date, Zuck's business seems to be in the best shape of the lot. There's never any shortage of regulatory risk, unfortunately, though, with the blockbuster trial against the FTC about to kick off. There are a lot of social media platforms out there, so it feels a bit wild to me that the FTC could force Meta to break up and divest some of its assets, particularly while the US government is also actively trying to kill off competition like TikTok. Stranger things have certainly happened, though, so this is clearly a risk that cannot and should not be completely ignored. Still, the underlying business at Meta is such a cash cow, and it has such wide reach. Sure, they are exposed to things like advertising revenue, but Facebook Marketplace, for example, is just a gem of a thing, and the tariffs that increase the prices of new goods will surely encourage even more activity around second-hand goods. People like to joke about how Facebook is only for boomers, but the stats do suggest otherwise, and there are plenty of people using the platform every single day, even if they may not be posting as much as they were a few years ago due to changes in the algorithm. As for Instagram, WhatsApp, and the other opportunities in the group, it still feels to me like Meta is well positioned. I was underweight Meta relative to some of the other names coming into this story. So this was the only Magnificent 7 dip that I've bought thus far. I took advantage of it to say, okay, let me add a little bit more relative to some of the other names. I'm not blind to the risks of the FTC trial, but I can also tell you that if there is some crazy outcome out there that happens with the regulator, US tech stocks in general are going to have their valuations butchered. If your base case right now is that the FTC is going to force Meta to break up into various pieces, then frankly I would struggle to see how you can justify any technology exposure at the moment, because that is almost a systemic risk to the entire sector in the US. And finally, a short note on other dips, because guess what? There are a lot of other stocks in the market, even if headlines over the past year or 2 years or 3 years have been so focused on these technology names. I did buy a number of quality companies during the worst of the S&P carnage in the past week, and I also put on my first long position in Purple Group on the JSE. By the time I come back with next week's episode, who knows what opportunities the market will have dished up, and perhaps I'll dig into one or two of those other names in my portfolio. But good luck out there. These are super volatile markets, and you definitely need to keep a cool head, stay disciplined, and stay true to your style of investing or trading, whatever that style may be. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.